So in the last two lessons, we talked about assets, which are things that you own, and liabilities, which are things that you owe. So everything else that's left over is your equity or your net worth. So the textbook definition of equity is the value attributable to the owners of a business. It's the difference between the assets and the liabilities. So the definition you need to know is that equity is everything else. If your business has cash in the bank, which is an asset, of $10,000, and you only owe the credit card company, which is a liability, $1,000, then you have equity of $9,000. It's probably easiest to think of in terms of a house. So your asset is the house, and that's worth $250,000. Mortgage balance, which is your liability, is only $150,000. So that means you have equity of $100,000 in your house. And whether you're thinking about your business life or your personal life, equity is a very important part of the accounting equation. Assets equal liabilities plus equity. Just like assets and liabilities, you can also find equity on your balance sheet. If you found this video helpful, we're real accountants and CPAs who work with hundreds of small business owners just like you every day. Check us out at engagecpas.com to see if we're a good fit for your business. We also have business courses available to help small business owners understand their business. They're for you to learn about your financials, your taxes, how to pick the right entity, tax myths, and everything else about your business. Learn at your own pace. Check those courses out on the Education tab on our website. You can also find us on Instagram at Engage CPAs.